Here is what's happening in China that the Western media just does not talk about. A long-time family friend of ours recently came back from China. She hasn't been for over 8 to 10 years. She was astonished how much China has actually changed. The cities, the trains, the technology, the advancement of China is beyond belief. This is not what the Western media are talking about. But what shocked her actually, more than anything, was the queues outside jewellery shops and gold shops. Very long queues going around the block, snaking around. She asked a couple of people in the queue, what was going on. They're all queuing up to buy physical precious metals, either in jewellery form or in investment bar form or coin form. It's insane. This is your Joe Public. These are your uncles and your aunties. These are not professional investors. The West is suffering from a global debt crisis, obviously, but China has a severe insolvency crisis, instigated by, obviously, a significant property market downturn from an overbuilt situation, overcapacity in industrial production, and hence the Chinese government has instigated extreme monetary expansion to counter the insolvency issues that are in China. In 2025 alone, there's $4.5 trillion equivalent in renminbi that was pumped into the system. So investors, Joe Public, they don't want to touch the equity market, but they can't hold cash because the cash is being actively debased. So they're trying to find avenues of how to protect themselves from a wealth preservation standpoint. So they're piling into precious metals. It's understandable, I get it. The Chinese are asking the question, how do I protect my wealth? This is not a Chinese story, obviously. This is a global story. This is Asia Pacific, this is Middle East, it's particularly Europe, UK, America, Canada. We're in the largest global debt crisis in all of economic history, and we've got a leverage crisis on top of the Mount Everest of debt. This quite simply leads into monetary debasement. There is no other route. Quite a number of metals have been added to sovereign critical metal lists. This is incredibly important because one, obviously recognition of which industrial metals are incredibly important for the future forward planning of industrial production and build out infrastructure. But not only that, in the small print, they can do sovereign asset grabs of these resources as the supply and demand imbalances escalate and as the availability of these particular metals become ever more difficult to find. So holding on to paper assets such as ETFs, that comes with an enormous risk. Sovereign asset grabs are on the agenda. Force majeures are on the agenda. It's a foregone conclusion that we're going to go to a force majeure at some juncture across the ETF space. When is it going to happen? Incredibly difficult to say. This cycle leads us into the end of this decade, 2032. It could happen this year, it could happen next. Why risk wealth preservation on paper when the risks are so apparent and so obvious? Looking at simple data, for example, M2 money growth, US M2 money growth, and global M2 has actually been pretty similar. Since the year 2000 to the year 2025, the end of 2025, global M2 has grown by roughly, or global US M2 has grown by 400%. The S&P 500 has grown just under 400%. So it's underperformed monetary growth. This is an appalling state of affairs. Now, remember, the S&P 500 includes the Mag 7, the Magnificent 7. If you pull them out, the S&P 500 has been an appalling index to be in the last 25 years. But bringing the Magnificent 7 back in again, the S&P 500 has underperformed money supply growth. You're not seeing your wealth preservation there. Now you've got a number of institutions like the Morgan Stanley Chief Operating Officer or Chief Investment Officer stating that the 60-40 portfolio is dead. Well, I've been saying that for 3 or 4 years. They're now saying an allocation towards gold in particular should be closer to 20% of the portfolio. That's physically impossible, by the way. At the moment, if you include sovereign central banks, family offices, wealth managers, banks, as a percentage of total assets, they've got roughly around about 2.5% allocation to gold. But that includes sovereign central bank. Now, the banks themselves and the wealth managers and the pension funds, they've got an allocation closer to 1%. And if you move from 2.5% to 5%, gold will triple in price. It really is as simple as that. Now, going back to the data of year 2000 to 2025, gold has performed roughly 1,500%. I haven't looked at the numbers this morning. It's roughly 1,500% return, compared to less than 400% for the S&P 500. Silver is roughly 1,400%. Silver and platinum are in a significant global supply-demand deficit. They're in a fractional reserve system, so the leverage of paper to silver, for example, is anywhere between 300 to 400 to 1. If you include the leverage on the paper exchanges, the option contracts, the derivative of balance sheet contract, the ETFs, etc., there is an extreme leverage in the system. So owning physical metals themselves outside of the banking system in your own ownership title, remember these are investment grade precious metals, they're extremely liquid, but holding them in an allocated account, in a bonded vault preferably, and there are very few bonded vaults around the world, is incredibly important as a diversification strategy of your portfolio. Now remember, the construct of the LBMA and the COMEX exchanges are paper, very much paper exchanges. The Shanghai exchange is a physical exchange. You take delivery. Now, we've got an arbitrage situation at the moment. Effectively, Shanghai prices are roughly, in silver as an example, they're roughly 13% higher in arbitrage opportunity. So for example, Shanghai prices are trading over $100 today, while paper prices in the West are trading at $88. Why is that arbitrage not being closed? In a normal situation, that arbitrage would be rapidly closed by the West sending metal over from $88, sending it over to China and selling it at $100. An enormous amount of money can be made quite quickly. But quite simply, there is not the metal in the West. So the physical world is overtaking us. We're coming out of the paper exchanges and moving towards a physical pricing world now. That's incredibly important. Now, India is collateralizing silver now as of April next year. That's incredibly important because families that hold physical silver as investment holdings can now use it as collateral for banking loans. Gold's already been collateralized in India. There is an enormous amount of developments going on in the precious metal market behind the curtains in Asia Pacific and Middle East that the West are simply not aware of. It's not too late to get into this cycle. We've only just started. The bigger moves are still coming. If you want to find out more, then please contact us. And also, why not join our WhatsApp channel? A regular update on market developments, price actions, when to sell, when to buy, what metals you should be looking at. Join us now.